Priya buys a duplex. Daniel opens a brokerage account. Both of them tell their families the same sentence: "This is how I'm going to retire early." 20 years later, only one of those sentences turns out to be true. And it's not the one you'd guess from watching year one. Stick around, because by the end of this video, you'll know exactly why. Here's the setup, and I'm keeping it clean. No tricks. Priya and Daniel are both 29. Both make $62,000 a year. Both have been saving quietly for 5 years, and both just hit the same number, $80,000 in the bank. Same city, same job level, same starting line. The only thing that's about to be different is where that $80,000 goes. Priya takes her $80,000 and buys a $320,000 duplex. She lives in one unit and rents out the other. A strategy people call house hacking. Her mortgage, at a 30-year fixed rate of 6.8%, runs her about $1,670 a month. Her tenant pays her $1,400 a month in rent. So on paper, Priya's actual out-of-pocket housing cost drops to $270 a month. She tells her brother this at dinner, and he practically falls off his chair. "You're basically living for free," he says. Priya agrees. She feels like she just found a cheat code. Daniel takes his $80,000 and splits it 2 ways: 60% into a total market index fund, 40% into a dividend-focused fund, because he read somewhere that dividends feel more real. He sets up an auto transfer of $400 a month and does not touch it again. His roommate asks what he's doing with his money. Daniel says, "Index funds, mostly." His roommate says, "Cool," and goes back to his phone. Nobody throws a party for Daniel. Nobody ever does. Day 1, Priya has keys, a tenant, and a story that gets better every time she tells it. Daniel has a login screen and a number that hasn't moved yet. If you filmed both of their first weeks and showed them to a stranger, nobody would bet on Daniel. That's not a knock on Daniel. That's just how humans are wired. We trust what we can touch. But touching something and it making you rich are 2 completely separate questions, and this video is about the gap between them. For the first 2 years, Priya is living what basically feels like a financial glow-up. Her tenant pays on time. She's deducting mortgage interest and depreciation on her taxes, which knocks a real chunk off what she owes the IRS. She's watching listings for similar duplexes creep upward every few months. Every mortgage payment quietly moves a little more of the house into the hers column instead of the bank's. She feels, understandably, like an adult who's figured something out. Daniel, meanwhile, checks his account roughly once a season, because checking more often just gives him anxiety for no reason. Year 1, his $80,000 grows to about $87,000. Year 2, somewhere around $95,000. Nothing dramatic happens. No neighbor comments on it. No relative asks for advice. It's just a quiet, slightly larger number sitting behind a password. Now let's actually open the books, because this is where the story most YouTube videos skip. By year 3, Priya has collected roughly $50,400 in rent from her tenant. Sounds fantastic, until you remember, rent isn't profit, it's revenue. Her mortgage payments over that same period total about $60,120. Remember, she's paying for her own unit too, so this isn't a pure investment property, it's a hybrid. Property taxes have cost her close to $9,000 over 3 years. Insurance, another $4,500. In year 2, her water heater failed, $1,100 to replace. In year 3, she had 1 month of vacancy between tenants that cost her $1,400 in lost rent plus $500 to clean and relist the unit. She's also been doing all of the tenant coordination herself. Showings on weekends, a plumber call at 11 p.m. when a pipe backed up, texting back and forth about a broken garbage disposal. None of that shows up as a dollar figure, but every landlord will tell you it absolutely costs something. When you actually run all of that through the math, Priya's true net housing savings over 3 years, the real number after every expense, comes out to somewhere between $9,000 and $13,000. Still genuinely good, just nowhere near the basically living for free story she told at dinner. Daniel, over that same 3 years, has put in his original $80,000 plus $14,400 in contributions for a total of $94,400 invested. At an average annual return of around 9%, his combined portfolio is sitting at approximately $106,000. He has spent 0 hours on maintenance calls. He has fixed 0 garbage disposals. But, and this is important because fairness matters, Priya has one enormous advantage Daniel doesn't have: leverage. She controlled a $320,000 asset using only $80,000 of her own money. That's 4-to-1 leverage. Her duplex has appreciated modestly, maybe 4% a year, and is now worth roughly $360,000. Her equity, what the property is worth minus what she still owes the bank, has climbed to around $95,000 to $105,000. Some of that wealth came directly from her own money. A good chunk of it came from the bank's money working on her behalf. That's the one trick stock investors simply cannot copy. Let's talk about the part nobody puts in the thumbnail: the hidden ledger. Every rental property has one, and almost nobody shows it to you before you buy. Vacancy. Even in a good market, most rentals sit empty about 3 to 4 weeks a year between tenants. That's not a catastrophe. It's just a mortgage payment with nothing covering it that month. Maintenance. The standard rule of thumb is to budget 1% of the property's value every single year for repairs. On a $320,000 duplex, that's roughly $3,200 annually. Some years, it's a $150 faucet. Some years, it's a $6,000 furnace that dies in January and can't wait. Capital expenditures, roofs, HVAC systems, water heaters. They don't break gradually, they break all at once, usually in $4,000 to $12,000 chunks. And if you're not setting money aside monthly for this, you're not investing, you're gambling with better lighting. Tenant risk. A tenant who stops paying and knows the eviction laws in their state can cost you 3 to 5 months of lost rent, plus legal fees, before you ever get the unit back. That single bad year can wipe out an entire year of gains, sometimes more. None of this shows up in the $1,400 a month in rent. It just shows up later, when you're not expecting it. By year 7, Priya is on her second tenant. She's replaced the roof for $7,800. She's raised the rent to $1,600, which helps, but her property taxes have climbed with it. Her real, audited cash-on-cash return, the actual money she keeps relative to what she put in, is hovering around 4 to 6%. Solid. Not the practically free housing pitch from year 1. Daniel, at year 7, hasn't done a single new thing. His combined portfolio, including contributions, is somewhere around $178,000 to $195,000. He didn't pick winning stocks. He didn't time a dip. He just kept not touching it. And the gains on his gains have started generating more new money each year than his actual contributions do. That's the moment compounding stops being a boring line on a chart and starts becoming the whole story. Here's the honest way to describe what's happening underneath the surface. Priya's wealth is growing steadily, but it's earning her that growth. Every dollar of it costs attention, phone calls, and occasional stress. Daniel's wealth is growing on a curve. Slow enough at first that it's genuinely boring to watch, and then, quietly, faster than almost anyone expects. By year 12, Priya's duplex is worth somewhere around $410,000 to $430,000. Her remaining mortgage balance is roughly $195,000. That puts her equity at approximately $215,000 to $235,000. Total real out-of-pocket cost over those 12 years, after every mortgage payment, tax bill, insurance premium, and repair, somewhere between $18,000 and $28,000 on top of her original down payment. Daniel's portfolio, with his same $400 monthly contribution, and roughly 9% average annual return, is sitting at approximately $225,000 to $245,000. He's put in $80,000 upfront plus $57,600 in contributions, $137,600 total. Everything above that is pure, untouched compound growth, and he still hasn't fixed a single garbage disposal. At year 12, they're remarkably close. Priya might be slightly ahead because of leverage, but Priya has also spent hundreds of hours managing a physical asset, taken on nearly $250,000 in debt, and put almost all of her net worth into one property in one neighborhood. Daniel is spread across thousands of companies worldwide and has never lost a night of sleep over an unpaid invoice. This is where the two paths really start to split. By year 20, Priya's duplex is worth somewhere between $520,000 and $580,000. Her mortgage is paid off or close to it. Her equity sits somewhere around $480,000 to $560,000, depending on how the local market behaved. Over those 20 years, after every single real cost, maintenance, taxes, insurance, vacancy, at least one major renovation, her actual net financial benefit from the property beyond her original down payment lands somewhere around $60,000 to $100,000. Daniel's portfolio, at a 9% average annual return with his steady $400 monthly contribution, has grown to approximately $480,000 to $540,000. Total contributions over 20 years, $176,000. The remaining $300,000 plus is compounding that happened while he was doing literally anything else with his life. Net worth-wise, they land in almost the same neighborhood, somewhere between $480,000 and $560,000 apiece. But how they got there could not look more different. Priya worked for hers. Daniel waited for his. Priya carried stress, concentration risk, and an asset she couldn't sell in an afternoon if she needed the cash. Daniel carried volatility, real, occasionally terrifying volatility, but also freedom and the ability to access his money whenever he wanted. And here's the twist that changes the entire equation. If Daniel had simply bumped his monthly contribution from $400 to $600, an extra $200 a month, roughly the cost of 2 takeout dinners, his 20-year total jumps to somewhere around $610,000 to $670,000. In the stock market, a small increase in contribution gets multiplied by compounding for decades. In real estate, investing more usually means buying a second property, which means a second mortgage, a second tenant, and a second set of 11 p.m. phone calls. Scaling up in the market is a slider. Scaling up in real estate is a whole new job. Now, to be fair, and I want to be genuinely fair here because most videos on this topic pick a side and just build a case for it, the stock market has real, ugly risks that get glossed over constantly. Volatility is not a theoretical concept. In 2008, markets fell by roughly 37%. In March 2020, they dropped over 30% in a matter of weeks. If Daniel had $200,000 sitting in his account and watched it fall to $130,000 in a single month, that is not an abstract number on a screen. That is a genuinely stomach-turning experience. And the data on this is consistent. Most retail investors panic sell during crashes and buy back in only after the recovery has already happened, locking in losses at the worst possible moment. There's also no monthly check. A rental property, whatever its headaches, deposits cash in your account every month that you can actually spend. A stock portfolio mostly doesn't. Dividends exist, but on a balanced index fund, you're typically looking at a 1.5 to 2% yield. On $200,000, that's roughly $300 a month, which isn't replacing anybody's paycheck. And there's no leverage. Daniel used $80,000 to control $80,000 in assets. Priya used $80,000 to control $320,000 in assets. That kind of leverage when property values rise is a huge part of why real estate quietly creates more millionaires than the stock market does, according to multiple wealth surveys. And real estate has tax advantages, depreciation being the biggest one, that let investors deduct a theoretical decline in the building's value even while the property is actually going up in worth. Stock investors, outside of retirement accounts, simply don't get anything like that. So where does real estate genuinely win? It wins when the rent-to-price ratio in your specific market is strong. Generally, when monthly rent sits at 0.8% to 1% of the purchase price, meaning the cash flow works in your favor from month 1, not just in year 15. It wins when you treat it like an actual business, screening tenants properly, budgeting for capital expenses in advance, building real systems instead of managing everything by gut feel. It wins with strategies like house hacking, the way Priya did, where you slash your own living costs while someone else's rent builds your equity. And it wins if you understand tools like a 1031 exchange, which lets you roll profits from one property into another without paying capital gains tax immediately, a form of tax-deferred growth that stock investors simply can't access outside of retirement accounts. Real estate isn't a worse investment than stocks. It's a misunderstood one. And the stock market isn't some passive cheat code either. It's just boring in a way that happens to be extremely profitable if you can tolerate the boredom. Priya and Daniel both walked away from their choice at year 1 thinking they'd found the smart move. Priya thought owning something physical was the obvious path to wealth. Daniel thought automation would quietly do the work for him. Neither of them sat down at the start and mapped out the actual dollars, the actual hours, and the actual risk they were signing up for. Over 20 years, the real trap was never real estate, and it was never stocks. The real trap is choosing either one because of a headline, a podcast clip, or something a coworker said with total confidence at lunch, without ever running the numbers for your own life. If you found this breakdown helpful and want more data-driven content, hit the subscribe button and turn on notifications so you don't miss the next video. Thanks for watching, and I'll see you in the next one.